Okay, great. So it looks like we got most everybody who registered, and we're gonna roll in. So again, the topic is leveraging your IRA investments with non-recourse loan. I'm gonna spend a few minutes talking about self-directed retirement accounts, and then Roger will come in and talk about how to use leverage. Just a quick introduction of myself. My name is Dimitri. I'm the founder and president of SenseFinancial Services. And my expertise in creating self-directed retirement accounts. Just very quick disclaimer here that we do not provide legal, tax, investment, or professional advice. While I do have expertise in investments and various aspects, I'm not the professional that you need to speak with, but my topic is self-directed retirement accounts. So I'm going to spend a few minutes talking about this. And before I do, I wanted to share you a quick example, basically a quick client case study. And this is Jason. Jason actually, one of our clients, he's in Tallahassee, Florida, and he found us about 3 years ago probably, and he had a couple different retirement accounts. And he was concerned about the state of the economy and what his investments were doing. So he actually was looking for alternatives. And he did some research online, and he found us and contacted us. We had a consultation, and we were able to set up a self-directed 401k plan for Jason. And he was able to take some of his money, about $135,000 in a couple of different retirement accounts. He converted them into self-directed 401k, combined them, and he was able to buy a rental property in his 401k, invested in his brother's business, and also the rest of the money he put into a promissory note in a trust deed. So basically he became the bank, or his 401k became the bank. And his investments combined bringing him about $1,000 a month in a cash flow. And if you compare that with what he had prior to that, just basically he got out of the stock market because he did not want to lose any more money. He got tired of that. So his account was actually losing money to the inflation. And now he's seeing his account growing every single month. So that's been like 3 years ago. So imagine what it is now. So he probably owns another note in his 401k just from the cash flow that he received. And that's just one of the examples. We have many of the examples like that you can learn about. We're doing a client case studies every few often, and we have different examples of our clients that you can go on our blog. You can read some examples there. You can watch some videos. Once you have the power in your hands, the opportunities and possibilities just pretty much limitless. All right, so and if you're looking at this and you're seeing yourself kind of like where Jason was, and if you just like this picture here, which by the way, the credit goes to my daughter, the man says, I finally decided to put something aside for our retirement. And that's our plans to retire. So if you're looking at your statements and you're kind of seeing yourself in this picture, then there is hope for you. You can take control over your retirement account. While you cannot change the past, you can change where you're headed. You can change the direction, and you can make some significant changes and improvements. But so let's talk about the options. If you have a conventional retirement account, then you can set up a self-directed IRA, or you can set up a self-directed solo 401k. And I'll just spend a few minutes talking about each one of those. But quick comparison of conventional retirement account versus self-directed IRA or 401k. With the conventional, as many of you probably have retirement accounts with your custodians, whether it's Fidelity, Schwab, Chase, you name it. The investments are controlled by the custodian, and the only allowable investments are stocks, bonds, and mutual funds. That's pretty much your only options. And here is an example of a sheet that when I was working for a company years back, and we had a 401k, the representative will come in from the company about once a year, had a meeting with all of the 401k participants and gave us this or similar to this sheet with the investment choices. And as you can see, all of the investments are confined to the stock market, just very, very limited investment options. Now, if you have a conventional IRA, you may have a little bit more options, more choices of mutual funds, but it's tied to equities. It's still confined to the stock market, and you don't really have a true diversification. Some people tell me when they invest in mutual funds, they think they're diversified. That might be true to some extent. You're diversified in terms that your investment is broken in 100 different pieces and invested in 100 different companies, but you don't have a true diversification because all of that in just a conventional retirement, just conventional investments, stocks and mutual funds. But with the self-directed option, you have virtually limitless investment options. What you see here on the right side of the screen is just some of the most common options that people invest. Real estate, tax liens and tax deeds, mortgage notes. You can invest in business. You can buy real estate outside of the US. I have clients who own real estate in Canada, in South America, in India, and Japan. So as you can see, you can invest into something that you understand and have greater control. That's the key. And you can also do the same conventional stocks and mutual funds with self-directed as well. So what is a self-directed IRA? Basically, it is a tax-deferred trust account that is held with the IRS-approved custodian. So the custodian is required with an IRA, and it allows you to invest in non-traditional assets like stocks and mutual, beyond the stocks and mutual funds, like real estate and trust deeds and those options that we went over. Most of the people out there are not aware of existence of self-directed retirement accounts because your traditional institutions, they don't want you to know about that. Your stockbroker or financial advisor don't want you to know about that because they want to keep you invested because that's how they make money. But if you have your wealth managed by somebody else, and if they're getting paid regardless whether your investment's going up or down, you got to ask yourself, is that a good model? I don't think so. And that's actually was one of the reasons why I got out of this business. That I wasn't in financial planning and investments in the past, had my securities license, but I got out of that business because I knew that my clients could not control those investments, and I couldn't control those either. So there are some techniques that you can use to improve your performance, but ultimately, if you invest in some stocks, you have no control. But you do have much greater control when you invest in things like real estate. So let's look at the mechanics how self-directed IRA works. Well, number one, you got to open up an account with the IRS approved custodian. And then step number two is you got to transfer. You got to fund it. You got to transfer your existing IRA, 401k or 403b account that you had with your current custodian into the new custodial account. And then you as a account holder, you instruct or you direct the custodian on investments that you want to make. So you tell your custodian you want to buy a piece of property or you want to invest in a trust deed. And when you do that, unfortunately, the good news is that you have those options, but the disadvantage is that every time you do a transaction, it comes with the fees. So when you make those investments, or if you gotta pay the bill for your investment property, a repair bill or a plumbing bill or a property tax bill, you gotta instruct the custodian to pay that bill. Custodian will send the check, and then they'll charge you a fee for that. And so all of the income and expenses for the investments going in and out of the custodial account. So that's how the self-directed IRA works. Now, the alternative to that is solo 401k. So let me spend a few more minutes talking about this option as well. And solo 401k defined under Internal Revenue Code Section 401 subsection K as a retirement savings trust. Now, this plan is designed specifically for those people who are self-employed or own a small business. Now, it's not a new type of plan. It basically just your conventional 401k, but it's covering only the owner of the business and spouse, if the spouse is also involved in the business. And so basically it's a simplified version of the 401k. Increased interest in these plans was actually jumped up as a result of some tax changes in the beginning of 2000s. And those changes made many current benefits possible. So let's spend just a few minutes talking about the benefits and the eligibility. So first, eligibility. In order for you to establish a solo 401k plan, you have to have some sort of self-employment activity. It can be in any type, shape, or form. You know, you can be a consultant, you can be an independent contractor, you can be basically providing some services to somebody. As long as you have 1099 income that you report on your tax return on Schedule E, then you're eligible. And then second criteria is that absence of full-time employees. This plan is not able to accept any full-time employees. So you cannot have full-time employees working for your business. And then in the IRS definition, full-time means 1,000 hours or more a year, which equals to about 20 hours a week. Now, the structure of this is also pretty simple. Step number one, as a plan sponsor, you need to have some business activity, as I mentioned, which will be a sponsor of the plan. Step number two is going to be the plan is adopted by the sponsor. Step number three, the trust is created and you become the trustee of the trust. And trust is created specifically to hold assets of the plan. And then the bank account is open for the trust. It can be opened at any bank or financial institution or brokerage. And then all of the investments are made in the name of the trust, all of the income and expenses going back and forth between the bank account of the trust, and you have a checkbook control over the assets. So as you can see, it's a simpler option. It eliminates the middleman, the custodian, and also eliminates all of the fees that come with the custodian. So the benefits of the solo 401k are, number one, it allows you to contribute significantly more than the traditional IRA and 401k, and that limit is $59,000 for this year. The loan feature of the solo 401k allows you to borrow up to $50,000 or 50% of your retirement account balance before you retire for any reason, tax-free and penalty-free. So that's a great feature as well. It comes with the Roth type of sub-account that allows you to contribute up to $24,000 post-tax, regardless of your income. And the next is a checkbook control, which allows you to have a cost-effective administration, does not require a custodian. You as a trustee of the plan have a checkbook control, and your spouse can also participate in the account if spouse is involved in the business. And then last and not least, but which is very related to today's topic, is if you use the 401k to purchase investment property with leverage using loans. Roger will talk about this. An IRA, if you do it in an IRA, the income from that portion of the property will be subject to unrelated debt finance income tax. But that is not the case with the solo 401k. It's exempt from that rule. So if you think again about using a self-directed IRA to achieve a true diversification, then this is a great vehicle, because if your investments just in the stock market, it's just a single bucket, and the bottom may fall out and all of your eggs might get broken. So you want to diversify. Wise man said, which is recorded in Ecclesiastes 11:2, that you got to divide your portion to 7 or even to 8, for you do not know what misfortune may occur in this earth. So you want to spread your risk. You want to diversify it between different asset classes. And then just the last couple of slides here. What is it that you cannot do? There's a lot of things you can invest in, but the Internal Revenue Code 4975 defines prohibited transaction rules, and it says that you cannot invest your retirement account in collectibles, S corporation, and life insurance contracts. And also, it defines immediate family members cannot conduct any business with IRA or 401k. And immediate family members is yourself, your spouse, and your linear descendants and ascendants, and the spouses of the descendants, son-in-law, daughter-in-law. Also, those who have a fiduciary responsibility to the plan, and then any business or entity in which disqualified person has 50% or greater interest. So that's about my part, and I've kind of run through this very quickly because I wanted to bring Roger back in, and he's going to be talking about non-recourse financing, non-recourse loans. And but if you have any questions on what I basically flew over, you've got my phone number there and my email. I'll be happy to answer all of your questions, or we can schedule a complimentary consultation. Okay, so now I'm going to bring Roger back, but before I do that, let me see if I can just switch it back to him. Okay, so I think Roger is going to be able to share his screen right now. And while he's doing that, just a very quick introduction for Roger. Roger, go ahead and share your screen.
I appreciate that, Dimitri, the opportunity to speak with you folks out here and investors. The area of self-directed investing is really, we believe in this industry, the way to go for developing an independent retirement account so that over time you're in control. And a little
Roger,
bit of, go ahead.
Go ahead and share your screen, because we cannot see. Let's share your desktop. And while you're doing that, I'm just going to give you a little bit of background for Roger. He's actually a senior vice president of First Western Federal Savings Bank. And he will show you how to purchase or refinance your investment property inside of your self-directed IRA or 401k. And
you should be seeing my screen, I think. Are you not, Dimitri, out there at this point? I'm under the screen sharing mode, and yes, Drew says yes.
Okay.
You're
Great.
Seeing my screen, Drew.
Perfect.
Terrific.
Perfect. Yeah, for some reason, maybe I'm not on the right screen, but anyway. So go ahead and take it forward.
Terrific. So a little bit about myself and First Western. First Western Federal Savings Bank has been a portfolio lender, meaning we keep all the loans on our own books and service every one of them. And we've been a portfolio lender for 35 years. And what we have done is, as the self-directed retirement industry has prospered and grown, we saw an opportunity to get into the leverage and lending side of this business. And I have about 18 years of experience with this bank and about 30 years in lending totally. And we created the program here in 2008 to help people leverage their own retirement dollars into retirement assets and real estate assets that they can control and help grow their accounts. And what we have provided is a loan that is required by the IRS anytime that you're going to look at leveraging your own retirement dollars. You must have what's called a non-recourse loan to do that. And First Western Federal Savings Bank, we're not accountants or investment advisors, and we aren't qualified to provide advice on IRA rules, regulation, or eligibility requirements. So I would advise you to consult with your tax and investment advisors to do that. But once that's done and you're now ready to make an investment in real estate, we're here to help you purchase that. And just a few reasons why you may want to do that. I know Dimitri provides the plans for you to get into this, but real estate becomes an asset that you can touch, see, and feel. You can walk up to the front door of that property, walk in the door, and see your asset, as opposed to a paper asset that may be invested in Wall Street. It also offers that diversification that Dimitri mentioned, where you're not putting all of your eggs in the stock market or one basket. You may keep some money in the market, but you may invest money in real estate, in a business, or other assets that help diversify and spread out your account. And in today's marketplace, after the real estate meltdown, there's been a lot of properties and inventory come back onto the market. There's been some good reduction in purchase prices over that time to where they became affordable. The market is now stabilized and moving back up, so it's a pretty good time to buy if you're going to try to gain some capital over the time, appreciation, and you'll have the cash flow from the properties. What we're here today to talk about is what is a non-recourse loan, which is the specific kind of loan necessary when you're using a self-directed solo 401k or solo or IRA. And a non-recourse loan, what that means is the bank has no recourse back to you, the person. And think about this, if you're going to be borrowing the money and buying it through your, say, solo 401k plan, the plan is going to be the borrower and owner. The trust, in other words, is going to be the owner of that property and the borrower on the loan. And you as the person or trustee are not going to sign for the money personally. You're only going to obligate the trust to pay the loan back. But that means that upon default, we don't have any ability to collect the loan from you, the trustee, or any other assets within your trust or any other personal assets. All we could possibly do if the loan went completely south is to foreclose on the property, get the property back, and that's all we get. If there's a deficiency balance, we're just out. The beauty of these kind of loans, and I think it's really cool, is that you don't have to expose your whole personal life when you're going to go apply for the loan. We don't look at your personal financial statement. We don't look at your tax returns. You're not the borrower. Your self-directed plan is the borrower. So all we do is we focus on the property and the money in the account. I'll cover first, just so you have an idea what these rates and terms are, so you can understand that they're priced very, very competitively nowadays, and that there's a lot of options open. So if you are going to use leverage, what we do is we'll finance 60% of purchase price in most states on 1 to 4 family properties, and we write that over a fully amortizing 25-year loan. And we can fix that rate for 3, 5, or 10 years on our adjustable programs, and then beginning in year 4, year 6, or year 11, that rate would then just adjust once a year. And those rates, as you can see on the screen, our 3-1 ARM is as low as 4.25%, our 5-1 is at 4 7/8, and our 10-1 is at 5.5%. For those of you who may want to hold a property for 20 years, gradually pay it off and have it there when you retire, we do also offer a 20-year fixed rate. So if any of you are interest rate risk averse or so forth, you might want to go with the fixed rate. We also lend on commercial and vacation properties, anything 5 units plus. And at those kinds of properties, the rates are 1% higher. And we have a 3-1, 5-1, 10-1 arm there and a fixed rate as well. We tie the loans to the 1-year T-bill, and there are rate caps on the 2 and 6%, so that the rates don't go up or down too much on our 3 or 5-year arms. And there's also no prepayment penalty on any loan should you decide to pay the loan off early. So what does this process look like timing-wise? Let's say you put a property under contract today, and let's say you have a 45-day close. What does it take to do it? Well, you basically apply with our bank, and our application's right on our website. You fill that out, send it in to us along with items on the checklist that would apply, and we can make a decision typically in about 2 business days and close in about 30 days. So start to finish, 30 to 32 days is about the process it takes from the time you apply for your loan until the loan closes escrow and now your solo K owns the property. How do these loans are underwritten? So there's 4 main issues. Number 1 is, does the IRA or solo K have the money? And by that, what do we mean? Well, what we mean is the money for the down payment, which in this case is 40 to 50%, have the closing costs, and you still need some operating money on the sidelines. We don't want you to spend your last dime getting into a property, and now you have a repair or a tenant moves out, and now you have expenses that you have to cover. And in the world of self-directed retirement plans, you can't just reach in your pocket and write a check to Joe the plumber if he comes over and replaces the water heater. Nope, you have to pay any expense of the property through the retirement plan itself. So that's why you need to keep some money there on the sidelines, keep some reserves. So once again, to cover the money piece, you need a good down payment, 40 to 50% down, plus your closing costs, and then still have 15% of the loan amount in reserve. Let's say we make a $100,000 loan, for example. We'll want to see $15,000 still left in your plan. So that's how the money piece is. And all you do is you show me your account statement or you show me your bank statement where you have your solo K set up, and that proves the money. Simple as that. The other piece is, does the property cash flow? Because the property is really going to pay the loan back. So what we want to see is that the property produces more cash flow than necessary to pay all the expenses and pay the loan payments. So what that means is we want a debt service coverage of 1.25 or greater, and I'll get into what that means in a moment. Third thing is the property a good one? In other words, is it in good condition? Is it the right property in the right neighborhood? Is it in good condition? You just want to make sure that you're getting in a good property, because maintenance costs on homes and real estate can definitely add up, and you don't want to be feeding, this asset with a lot of your retirement money just to keep it going. You want to pick a good one to begin with that doesn't need a lot of care and feeding and maintenance expenses. And lastly, does this transaction just really make good common sense? And we're a common sense lender. We're out here in the Midwest. We kind of have these Midwest values of, do things just make common sense? And if they do, great. If they don't, well, maybe there's a reason why this deal isn't one you may want to put together. So let's take a look at that debt service coverage ratio and what that truly means. This is an example of what we actually do and go through when we're evaluating a property. And I would say to you, investors listening in here, use this example in setting up your pro forma income and expenses for properties so that you can tell if this thing is going to make money or not. So on an example here, we have a $100,000 property. The borrower put 40% down, or $40,000, and we have a $60,000 loan. So the property rents for $1,000 a month. That gives us gross rental income of $12,000. We build in a 7% vacancy factor, which really represents 1 month a year that the property is going to be vacant, and that's about as conservative as you can imagine. You really do need to plan that you will have some vacancy, so build in a vacancy percentage as your expenses. You'll also want to account for taxes, insurance, maintenance on the property, any HOA fees if there are any utilities that you might be paying for the tenant. And lastly, if you are not self-managing it, you may have a management company and you build in that expense. So on this particular property, it had $12,000 in income, it had expenses, and that left after expense net operating income of $7,360 per year. Net operating income, or NOI. You'll hear that term a lot. That is the income that the property produces after all the operating expenses. We as a lender then take your net operating income and divide that by your principal and interest payments that you're making over the course of a year. And that fraction, in this case $7,360 in income divided by $3,900 in principal and interest payments, shows us that the income is really 189% of the debt service, or in other words, in a debt service coverage ratio 1.89. Here's another one I did on a condominium. It was a home in an HOA, which a lot of homes in developments that have swimming pools and clubhouses and tennis courts and some amenities will have an HOA fee on that to pay for that those items. So in this case, it was a house costing $184,000. We lent $92,000 on it. The income was $1,300 a month. Again, we build in the expenses of vacancy, taxes, insurance, maintenance, HOA fees. In this case, there were no utilities and no management, so the net operating income at the end of the year was $9,308. To get that debt service coverage, you take the $9,308, you divide by the $6,373 in principal and interest payments, and you can see that your principal and interest payments are covered 1.46 times, or 146%. That's a good deal. We need to see as a lender at least a 1.25 debt service coverage ratio. Lastly, here's an example of a commercial building, and this was one that a client did in another state. The tenant paid all the taxes, insurance, and maintenance. It was a triple net lease. So on commercial, we're typically going to lend 50%. So on a purchase price of $600,000, we have a $300,000 loan amount. The income for the year was $60,000, and coming off that $5,000 a month lease. There's our vacancy factor built in of $4,200. Taxes, well, zero to the owner because the tenant's paying the taxes. Insurance, same. The tenant's paying the insurance. Tenant's probably going to pay regular maintenance, but sometimes large items the owner will pay for. I built in some money there for large items. And management, in this case, they were having, it was in a different city, so they had a management company manage the property for them. And after subtracting out all those expenses from their $60,000 a year income, the property made $47,400. The loan payments on a 15-year loan, and I typically write commercial properties on a 15-year loan, came out to $30,136 a year. So taking your debt service coverage, your net operating income $47,004 divided by your principal and interest, you now have a debt service coverage of 1.57. Again, this building is making money, it's producing income, throwing off positive cash flow. That's what we like to see. So that's how the process, and that's how we take a look at the cash flow, because that's really going to pay the loan back. But there really are then other factors, particularly in real estate, that you need to look at to be sure that you're getting into a property that's going to make you money and not going to cause problems. And this is where you really have to do your due diligence. One, if you're buying in a condominium or townhome, homeowner association, get 2 years of financial statements, income and expenses, and a budget for the HOA. Ask for those. If you have a purchase agreement and you're buying a property within an HOA, the seller or the seller's realtor is obligated to show you those financial statements. You want to see what you're getting. If you don't open them up, shame on you that you haven't done your due diligence. But I'm going to ask for them anyway, so go ahead and get those. Crime. Look at some different websites. I use one called Trulia, and just as an example. Trulia.com shows crime. If you punch in the address of the home that you're looking to purchase, it will actually have a crime graph or a crime grid for that neighborhood on the levels of crime. So again, crime is a big one. You don't want to buy in a high crime area because you're going to have high turnover of tenants and no appreciation on your property. So crime really will play into where your property is going to go in the future. Condition: the property needs to be nearly rent ready. It doesn't have to be perfect. I can finance a property that may need some carpet and paint and appliances, as long as the property doesn't need more than $10,000 in repairs to make it rent ready. We can finance it. Unlike, let's say you went out to purchase a property personally and you're getting some kind of a Fannie Mae or Freddie Mac government loan, if there's issues with the house, they're not going to let you close on that. Our bank, however, if you're an investor and we have confidence that you know what you're doing and they're small items to make ready, we will let you close on the property with the idea that you'll get these repairs taken care of in 60 days or less, and you'll get us the receipts showing they're all taken care of and paid for. And that way it addresses the items that you want to put into the home before that tenant moves in, so that it now is all set up. And by the way, speaking of that, we finance many, many properties that have never had a tenant in them. A lot of properties investors are buying are owner-occupied, and that's fine. It doesn't have to have a rental history. Just go back and use that example that I did in terms of debt service coverage and do an analysis. Do your income and expense analysis of that property, and make sure that that thing works and cash flows, and that's what you have to do. Lastly, we want to make sure the property is 75 years old or less. We like to see something built in 1940 or newer, simply because more than likely you're going to have less maintenance and upkeep costs. There are some things that truly can derail a non-recourse loan, and the last thing you want to do is get into a purchase situation where you're now 20, 25 days into the process and something crops up that is going to kill the deal. So there's things to watch for here that you should look at. We're going to look at as a lender for certain, and these issues, if you can avoid them, will help you get a loan approved. One is, make sure when you're plotting out your pro forma income for your property you're going to have as a rental, that you get good data. Talk to management companies in the area. Talk to realtors if they have experience with rental pools. Find out what that property really will rent for, because the worst thing you can do is say, well, it's going to rent for $1,500 a month. And we're going to do a check to your work. We're going to assume you know what you're saying, and so we're going to underwrite the loan at $1,500 a month. But the check to your work is when it comes time to have that property appraised. We will ask the appraiser to do a rent comparable of that property to other properties in the neighborhood. So the appraiser will go out and look at 3 other rentals in that tight group neighborhood and determine what market rents are. And let's say market rents come in at $1,200 and you have based your whole model on $1,500 a month. That's $3,600 a year that's not going to come in. We have to use the appraiser's figures, by the way, because they're a neutral third party. So if the appraiser says $1,200, now I have to use $1,200, and your expense computations may show that it won't cash flow. So sometimes what will happen, or this will happen too on a vacation property, someone says, oh, it's going to generate $50,000 a year. Well, let's say it generates $35,000 on the appraisal. We got to use $35,000. We may have to lower your loan amount to where it does hit that cash flow point. So I guess this is the one that I probably see most often that becomes an issue, is when people overestimate what they can get for rental income. Underestimating is great. Overestimating, not so much. Another thing that's problematic is buying the most expensive property in the neighborhood, because what happens is you can't get any comparable sales when you go to do an appraisal on that property that justify that price. And now, instead of the property coming in with an appraised value of, let's say, $125,000, the rest of the properties are $100,000 properties. It's probably going to derail the loan. So, maybe the least expensive home in the neighborhood is a much better bet than the most expensive, because your surrounding properties are going to average out. High crime areas, I touched on that before. Make sure if you're buying a property in an area of town, do your research and make sure that thing is not in a high crime area. Something that may need to be done from time to time on properties, maybe a home inspection. You don't really know the condition of a roof per se. It may look kind of okay, but you probably want to get a home inspector up on that roof to make sure that you don't have an $8,000 roof to be replaced right around the corner. And so condition of property can have me turn a loan down. It just, foundation's got problems, the plumbing has got some problems, electrical issues. So, again, make sure the property that you're purchasing is in good condition. Another thing, global debt service. Here's one issue that if you investors have more than one property and more than one non-recourse loan, we as a lender need to take into account your debt service that your retirement plan has to pay on all IRA loans. So let's say you have a loan with our bank and a loan with another entity and maybe even a non-recourse loan with a private investor. We have to take all those loans into account to make sure that your plan can afford all these loans and still have a cushion. One other thing, too, that, again, is an issue is reserves inadequate, or that's that 15% I'm talking about. We'll want to see 15% of all IRA non-recourse loans that you have with all lenders in a liquid position in your retirement account. Now, it doesn't have to be all in cash. It could be in some mutual funds or stocks, or you might park some of your money in the market. That's fine. Those count as reserves because they're liquid. You can turn those stocks or mutual funds into cash in just a couple of days should you need to invest money back into the property. So, again, make sure you have the reserves, not only for our loan perhaps, but other non-recourse loans. So, again, make sure that the property you're buying is a good one, and you try to avoid these issues that I have up here because they can certainly derail your loan. They can also cost you a whole lot of money if you get into a property that has these characteristics, even if you don't have a loan. What kinds of loans or entities are acceptable? We as a bank will make a non-recourse loan to any self-directed IRA. LLCs made up of single or multi-member IRAs, or self-directed solo 401ks, or LLCs made up of 401k members. Let's say that you have $60,000 in your 401k, and you see a property that's maybe $200,000, and you sure would like to buy it, but you don't quite have that 40% down. You may have another investor, partner, friend, who has a solo 401k as well with money into it, and you may decide to go together as a partnership and purchased this property. So what you might do is form an LLC made up of two 401ks as the members. And then the LLC is the entity that owns the property. The LLC borrows the money. The LLC is what makes application to our bank. And we make the loan to the LLC. So again, we're making these non-recourse loans to the entity, to your retirement plan, not to you personally, so you're not obligated. It doesn't go on your personal credit. This loan does not show up on any credit bureau you're going to have because you're not the borrower. The plan is. What will we lend on? Well, we will lend on residential properties, and by residential I mean single-family homes, condominiums, townhomes, multifamily. Maybe you have a duplex, triplex, fourplex, eightplex, tenplex, apartment building, whatever, multifamily apartments. Just as a caveat to that one, if we are going to lend or entertain a loan on an apartment or multifamily, we do like to see cost per door of $35,000 to $40,000, simply because we want to get into at least financing a quality level of housing stock that's at a medium at least or better. I don't want to finance a $100,000 tenplex. I mean, that'd be $10,000 a door, and you might be in a pretty rough area. So again, multifamily of any size or shape. We'll finance commercial properties. Maybe there's a strip center down the street from where you live that looks like a good candidate. You can keep your eye on it. Maybe you want to buy that commercial building with your solo K. Condos. I've seen a fair amount of commercial condos where a person will take their retirement money, buy a condo in a doctor's office, medical clinic, and they lease it to a doctor. It's a great return. So commercial properties, office warehouse, those are fine. Another type of property that does well in terms of income, if you know farming, is you might buy a farm, buy some ag land, and then you lease that ag land out to the farmer next door who's going to put crops on it and pay your retirement plan rent every month. So we'll finance farms with income up to 50% of the cost of the farm. Same with commercial. And we lend in all 50 states. First Western Federal is a dedicated player and lender in this market. We've been in this market now over 7 years in the non-recourse solo K and 401k and self-directed IRA financing world. We lend in all 50 states. I'm one of the underwriters. My partner here and President Jeff Fullerton is the other one. So when you call our bank and you're wanting to talk to somebody, you're going to talk to either myself or Jeff, and you'll talk to a decision maker. So you know when you're talking to myself, I'll give you the straight answer, and if I tell you, yeah, this looks like a deal we can finance, you can count on what I say. My word's good. So I would ask you now if you have any questions. I'd certainly like to entertain questions. Dimitri, if you wanted to field those questions, perhaps from the participants, and then ask me, I'd be happy to share an answer with you folks.
Sure. We actually have a few questions come in, but folks, if you do have any questions, just go ahead and submit them in the chat box so I can get them over to Roger. First question is from Jason, and he's asking, how long does the process take? So if you can talk about the timeline.
Yep. The timeline, and I'm going to flip back here real quick to this earlier slide. It takes about 30 to 35 days from start to finish. From the time you apply, we normally can get you an answer in about 2 days if we have all the information, and I'll tell you how that works. We have our application on our website, which is myiralender.com. You'll see that domain at the bottom of that slide. You go there to the application process, and there's our application, and you can just fill that app out, and there's a checklist attached to it. And what you would do then is send us each and every item on that checklist that applies. And the more of those items that you can get in on the first go-around, we can get to an answer quicker. But a couple days to make a decision, and about 30 days after that to close. Another question?
Yes. Mary is asking, do you lend on properties that I already own?
Yes. We can do either purchase money or cash out refinances. So if you already own a property within your plan and it's producing income, I can lend up to 60% of what you paid. In most states, some states 50%. If you bought a property, it may have needed some work and you rehabbed it. I, in most cases, will give you credit for purchase price plus your rehab dollars you put in there. Let's say you did buy a property for $80,000 and put $20,000 in some pretty good rehab to it and have $100,000 into it. Generally, I can finance 60% of that $100,000 you have invested. So refi or purchase, either one, good to us.
Okay, great, thanks. Kathy is asking, are your loan rates and other terms posted on your website?
Our rates are not posted on our website, but I will do this. If any of you have a question on rates, you can send that question to Roger at myiralender.com. That's my email address, is ROGER, Roger at myiralender.com. And I will email back to you what I call our lending parameters. I don't publish those rates on the website. They don't change often, hardly at all, but I will send you our rate sheet and lending parameters personally. So if you want to see those rates, don't hesitate to just call or email me.
Okay, great. And then we got a question from Susan who's asking, what is the minimum you lend on single-family homes?
Minimum dollar amount is $40,000. So that's it, $40,000. And it takes really an $80,000 to $90,000 property really for us to lend $40,000 to $50,000 on it. Just so you know, I don't lend on $20,000 to $30,000 properties or group multiple ones like that together to get to a big enough value. Speaking of that, I will, and I have many times, cross-collateralized or grouped several properties on one loan. Let's say you own a property already free and clear and you want to buy another one. Instead of selling your existing property or something, I could take that existing property plus the one you want to buy in one loan, and you just pledge that free and clear property in lieu of a down payment, and now I finance the new one. So you may not have to outlay any dollars in your plan if you're buying a property and you already have a property that has a lot of value already. We could use both of them to secure the loan.
That's a great strategy. Now, will that work on a property that has financing but has significant equity?
Well, I want to be in first position, Dimitri, so if there was an existing loan on it, we would need to pay off that loan and move into first. But, if there was plenty of equity in there, there may be plenty of equity to do that kind of thing. Let's say there was a low balance, $30,000 on a $100,000 house. Well, there's at least $30,000 of extra equity in there I could lend on. So yeah, it's possible.
Gotcha. Okay, makes sense. Now, will you lend on condos and multifamily over 4 units?
Yes, I do quite a fair amount of condo financing and multifamily both.
Now, as far as the condition of the property or the age of the property, will you finance older properties?
There are instances where it does make sense to finance something older than 1940. There's a lot of areas of the country, particularly up in the Northeast, where the average housing stock is at least 100 years old. Many of those homes have all been brought up to code. So I'll tell you this, if the property you're looking at is older than 1940, but all the electrical, plumbing, HVAC, foundation, roofs, all are in good condition, and you get a home inspection from a licensed home inspector and provide that to us for our review, and it comes out clean, then yes, I can lend on an older property. It just has to be one that is in good shape, does not need deferred maintenance, and all the components are good. But I'll make an exception if we have a home inspection and it's a good property.
Okay, great. Well, thanks so much, Roger, for joining us today. Great information, and I'm sure you'll probably help some folks to grow their wealth, because using a non-recourse financing, especially in a 401k, is a great way because there is no UDFI tax. I used personally non-recourse loan to buy real estate in my retirement account, and I think it's a great way to grow your wealth.
Thank you so much, Dimitri, and all of you at Sense Financial for the opportunity, and thank you, all you investors out there who are participating, listening. It's been a pleasure for me to help. Anytime you need anything, call me.
Great. Thanks again, and have a good night, everybody.
You too. Bye-bye.